On that crisis of confidence in China, I just wonder whether you think markets are starting to price this in, whether they need to start to price this in as we look at Bank of America saying that maybe there's further downside of about 4% on equities as a result of not just higher rates, but also the China risk.
I mean, certainly the price action since Friday has been particularly bad here. One of the dynamics I've been talking about for the last couple of weeks is that I'm actually surprised, well, not surprised, but I'm noting that Chinese markets aren't trading as badly as the news flow. And still, if you look at a one-month window, they're still outperforming most global assets on a one-month rollback. I've just checked to confirm that significantly, but that's partially because all markets are selling off at the moment. However, the price action Friday afternoon and today really was quite negative and does show that, there is still possible more downside here. But I think this is a market that is trading very, very broken, and I think it's hard to get really, really dramatically bearish about it. What I think might be more consequential is that maybe some of those second derivatives haven't yet priced this. Maybe there's more money to come out of other Asian stock markets that are correlated to China. Maybe there's more money to come out of, for example, some of the EM trades globally, and then maybe there's some more money to come out of some of the metals markets as well. So those second derivatives might be where there's more follow through if the China story continues to trade bearishly from here.
Mark, do you think the LNG story, the gas price story, is that going to be back in terms of dominating our attention? Is it going to be back amongst the mixed in terms of higher rates, China, and then suddenly gas? Is it moving from a tail risk to a central risk?
I think it's still only a tail risk because we've got such high storage. We've prepared for this. The last 3 years have been such a shock to the system. And I will talk about this a little bit later, but I think that one of the dynamics where it really impacts is the idea that it's a problem for the German economy, which is already under pressure. So the German economy is being squeezed by the fact that China's economy is struggling so much, where it has such a large amount of trade and higher natural gas prices, and that's really problematic. And then the final thing is that, hey, we're suddenly moving to an EV world that's dominated by BYD and Tesla, and therefore the German automakers, one of the key sectors for the German manufacturing sector, are getting squeezed as well. So it's really getting that trifecta of issues that have come around to China and natural gas primarily.
And now throwing ahead, Mark, to Jay Powell, Jackson Hole, the speech towards the end of this week. There was a bit of a surprise last year. Markets fell on the back of his speech. What do you expect to hear from the Fed chair?
So I think he won't actually say too much exciting, but like all these things, it's how does that impact relative to the pricing? I think we've had a market that is pricing for him to kind of reiterate the inflation fight, and they've not won, so therefore they're positioning for him to be slightly hawkish. And therefore, I think if anything, there's the risk is he surprises slightly dovish relative to expectations, because he might kind of go, look, we might be near the end of the cycle. He might open up more idea to those doves. So what I do think could be the impact, though, is that ultimately over the next couple of months, we could still see further steepening, because it might be the front end that's more anchored now, whereas the supply dynamic that is going to continue to weigh on long-end treasuries, and therefore I think we could see the curve steepen further, and 10-year and 30-year US yields continue to climb from here.